Ever feel like you're at one of those, those parties
Hmm.
where the music's just like blaring
Oh, yeah.
and everyone's kind of like bouncing off the walls and you're thinking, this is fun, but how long can this really go on?
Right. Like, someone's got to turn the music down eventually.
Exactly. That's kind of how I feel about the stock market right now. It's been on this incredible run,
It really has.
but is it sustainable?
Yeah.
Are we headed for a major crash? That's what we're going to deep dive into today.
It's a question a lot of folks are asking, and for good reason. I mean, we've seen this almost unprecedented market exuberance over the past year. Returns are nearly double the 50-year average of 12%.
Wow, double. That's pretty wild. It makes you wonder if it's a little too good to be true.
Right. And that's where things get interesting, because when you look at the underlying U.S. economic growth, it's actually been slower than its 50-year average.
The market's partying hard, but the economy's not exactly keeping pace.
That's one way to put it. And that disconnect, that's what's raising those red flags for a lot of analysts.
Okay, so we've got this potential disconnect between the market and the real economy. What does that mean for us regular investors?
Well, one way to gauge the mood is to look at the Fear and Greed Index. It's basically like taking the temperature of investor sentiment.
I've heard of that. Doesn't it basically tell you if investors are feeling optimistic or totally freaking out?
Exactly. It takes into account things like market volatility, trading volume, all sorts of factors. And right now it's showing a growing sense of bearishness.
Bearishness meaning more and more people think the market's about to drop.
Exactly. They're worried about a correction. And you know what? That fear itself can actually become a self-fulfilling prophecy.
Because if everyone starts selling off their stocks,
It can trigger a domino effect, pushing prices down even further.
that makes sense. So, okay, how do we figure out if the market really is overvalued?
Yeah.
I always hear those terms like PE ratios and multiples, and honestly, it all just sounds kind of confusing.
I hear you. It can definitely sound like a whole different language. Let's try and break it down. Imagine a company's earnings are like the profit from a lemonade stand.
Okay, I can picture that.
You wouldn't pay the same price for a stand making $100 a year as one making $1,000, right?
Of course not. The more profitable the lemonade stand, the more I'd be willing to shell out to own it.
Exactly. And that's where multiples come in. It's basically how much you're willing to pay for each dollar of a company's earnings. Historically, the S&P 500, which tracks 500 of the biggest U.S. companies, has traded at an average of about 15 times earnings.
Okay, so using your lemonade stand example, if a stand's making $100 profit and the average multiple is 15, that means it's valued at around $1,500.
You got it. But here's the thing. As of February 2025, the S&P 500 is trading at roughly double that historical average, close to 30 times earnings.
Wait, so our little lemonade stand is suddenly worth like $3,000.
Precisely. And that's what's fueling this whole debate about overvaluation. Some experts say this high multiple is justified by factors like low interest rates, but others are saying it's a classic sign of a bubble and that a correction is coming whether we like it or not.
Okay, so we've got some red flags here.
Yeah.
Market outpacing the economy, investors getting nervous, and these sky-high valuations. But I'm guessing there's another side to this story. Why is the market still so strong, despite all these warnings?
Oh, absolutely. There are some powerful forces at play here, and it's important to understand them before we jump to any conclusions.
All right, lay it on me, because honestly, I'm feeling a little lost here.
Well, for one thing, there's just a lot of money sloshing around in the system right now. Think about all those pandemic stimulus packages and all that quantitative easing.
Oh yeah, all that money the government was basically printing.
A lot of that ended up flowing straight into the stock market.
More buyers, more demand prices go up. Classic
Yeah.
supply and demand, right?
Exactly. And it's not just the big institutions driving this trend. We've seen a surge in retail investors.
Everyday people like me and you.
Exactly. And that's partly because investing has become so much more accessible.
Oh yeah, with all those apps and online platforms. Anyone can be a day trader now.
That's right. The barriers to entry have basically vanished. And it's brought in a whole new generation of investors, many of whom are younger.
So they're less risk averse, more comfortable with seeing their investments go up and down.
Exactly. They're more likely to chase those high-growth stocks, which further fuels the boom.
So we've got this perfect storm brewing, tons of money, easy access, and a new wave of investors who aren't afraid of a little volatility.
It's a recipe for a bull market, that's for sure. And remember, markets can stay irrational a lot longer than we might expect.
So what's the average investor supposed to do with all this information? It feels kind of overwhelming.
Well, that's where understanding different investment strategies comes in. Broadly speaking, you've got two main approaches: passive investing and active investing, each with its own pros and cons.
Okay, let's break those down because I think a lot of folks listening are probably wondering, where do I even start?
Sure. So passive investing is often called the set it and forget it approach. It's about riding the long-term upward trend of the market without trying to time it perfectly.
So if you're not a financial expert or you just don't have time to be constantly checking the market, this could be a good option.
Exactly. One common passive strategy is investing in those broad market ETFs, like SPY or VOO, which track the S&P 500. You're basically buying a tiny piece of all those 500 companies.
So you're not putting all your eggs in one basket. You're spreading the risk.
Exactly. And another key part of passive investing is dollar cost averaging. Instead of trying to time the market perfectly, you invest a fixed amount at regular intervals, like monthly or quarterly.
So even if the market dips, you're still buying in at a lower price, which can actually work in your favor in the long run.
That's the idea. Passive investing is generally considered lower risk with lower potential returns compared to active investing. But for a lot of people, it's a solid, straightforward approach.
Okay, but what about those folks who want to be a little more hands-on, who want to try to beat the market? What's active investing all about?
Active investing is where you really roll up your sleeves and try to outsmart the market. It's about finding those specific companies or sectors that you believe are going to outperform everyone else.
So instead of buying a piece of the whole market, you're trying to pick and choose the individual companies that'll become the next big thing.
Exactly. It's about finding those hidden gems before everyone else catches on. Obviously, the potential rewards can be huge if you're right.
But I'm guessing the risks are a lot higher too. You could end up picking a dud.
Absolutely. Active investing is not for the faint of heart. You need to be comfortable with the possibility of losing money, and you need to be willing to put in the time and effort to do your research.
Okay, so we've got passive investing, the slow and steady tortoises, and then we've got active investing, the hare sprinting ahead, hoping to win big. But no matter which approach you choose, we need to remember there are no guarantees in the stock market.
That's absolutely crucial. We can't talk about the market without acknowledging the reality of recessions and volatility. The economy goes in cycles, upswings, and then those inevitable downturns.
Right? It's not always going to be smooth sailing. There are going to be storms along the way, and those storms can get pretty intense.
They absolutely can. Just look at the data. Over the past century, we've seen 16 recessions in the U.S. That's more than one per decade. And we've had 25 bear markets, which are drops of 20% or more in the stock market.
Wow, that's a little scary.
Yeah.
So for everyone listening out there, are you prepared for that inevitable downturn? Do you have a plan for when things get bumpy? Because I think that's a really important part of this conversation.
It is, because when those corrections hit, it's not the time to panic and make rash decisions. It's the time to have a solid plan in place.
Like a financial safety net. Knowing that even if things go south, you've got a strategy to help you weather the storm.
Precisely. And that plan should take into account your own individual risk tolerance.
Right, because let's be real, everyone's different. Some people are totally fine with those big market swings, while others prefer a smoother ride.
Exactly. You got to be honest with yourself about how much volatility you can handle, both financially and emotionally. Because watching your portfolio go up and down can be stressful.
No kidding. And I think it's important to remember that investing isn't just about numbers. It's about your goals, your dreams. What are you investing for? Retirement, a down payment on a house. Having that clear sense of purpose can really help guide your decisions, especially when the market gets crazy.
I love that. It's about aligning your investments with your values and your aspirations.
Okay, I want to circle back to something you mentioned earlier about active investing, because it sounds really interesting. You talked about how understanding those market shifts can be key to identifying opportunities. Can you elaborate on that? Because it sounds like there's a lot happening right now that could create some really interesting possibilities.
Oh, absolutely. The market is constantly evolving, reacting to everything from new technology to global events to changing consumer behavior. And savvy investors, they're always on the lookout for those emerging trends that could signal big winners or losers in the game.
So it's almost like you're trying to predict the future.
Well, it's not about predicting the future with certainty, but more about understanding the forces that are shaping it. For example, let's look at the rise of artificial intelligence.
Aye, aye. It's everywhere these days.
Exactly. It's transforming industries from healthcare to finance to manufacturing. So an active investor might ask themselves, which companies are leading the charge in AI? Which companies are best positioned to benefit from this disruption?
So you're not just buying a stock because it sounds cool. You're really doing your research, digging into the company, understanding its potential for growth, in this new AI-driven world.
Exactly. You're looking for companies that are innovative, but also financially sound with strong leadership and a clear vision for the future.
So it's kind of like you're a detective piecing together clues, trying to figure out which companies are going to be the next big thing.
Another big shift we're seeing is the growing focus on sustainability and ESG investing. That's environmental, social, and governance factors.
ESG, I've heard that term. What does it actually mean for investors?
It means more and more people are looking for companies that are aligned with their values. Companies that are committed to things like ethical practices, environmental responsibility, and social impact.
So it's not just about making money anymore. It's about making money in a way that feels good, that aligns with your personal beliefs and contributes to a better world.
Precisely. And this shift towards ESG investing is creating a whole new landscape of opportunities in sectors like renewable energy, clean technology, sustainable agriculture, and social impact businesses.
So if you're passionate about fighting climate change or promoting social justice, you can actually put your money where your mouth is.
Exactly. You can use your investments to support the causes you believe in while potentially generating a financial return.
It's like a win-win. You get to make a positive impact and potentially grow your wealth at the same time.
These are just a couple of examples of how understanding those market shifts can really inform your investment decisions. The key is to stay informed. Be aware of the trends shaping the world and think critically about how they might translate into investment opportunities.
So active investing is all about connecting the dots, seeing the big picture and anticipating where things are headed.
Exactly. It's a dynamic and engaging approach to investing that can be incredibly rewarding for those who are willing to put in the time and effort.
But it's important to remember that active investing is not a get-rich-quick scheme. It takes patience, discipline, and a willingness to learn from your mistakes.
And even the most successful investors make mistakes. The key is to learn from them, adjust your strategy, and keep moving forward.
Okay, so we've covered a lot of ground here. We've talked about historical market trends, investor psychology, those valuation metrics, passive versus active investing, and the importance of understanding market shifts. But I think it all boils down to this. Do you see the current market as an opportunity or a warning?
That's the million-dollar question, isn't it? And there's no easy answer.
Because on one hand, you've got those record highs, the potential for continued growth and the excitement of discovering the next big thing. On the other hand, you've got those warning signs of overvaluation, rising interest rates, and all that geopolitical uncertainty.
And it's important to remember that every investor is different. We all have different financial goals, risk tolerances, and time horizons.
So what might be a great opportunity for one person could be a huge red flag for someone else.
Exactly. There's no one-size-fits-all approach to investing. The key is to do your research, understand the risks and rewards, and make informed decisions that are right for you.
And that's what this whole deep dive has been about. We're not here to tell you what to do with your money. We're here to equip you with the knowledge and insights so you can make those decisions for yourself.
We want to empower you to be a confident and informed investor, no matter your level of experience.
Because at the end of the day, investing isn't just about numbers. It's about people.
Yeah.
It's about your dreams, your aspirations, your vision for the future.
And we believe that everyone deserves the opportunity to achieve financial well-being and build a brighter future for themselves and their families.
So to everyone listening, we want to hear from you. What are your thoughts on the current market? What are your investment goals? What questions do you have? Share your thoughts and experiences in the comments below. We're all here to learn from each other.
Because remember, investing is a journey, not a destination.
And the more we learn and share, the better equipped we'll all be to navigate that journey and reach our financial destinations.
So keep learning, keep exploring, and keep investing in yourself and your future.
And that's a wrap on part one of our deep dive into the stock market. It's like having that game plan ready,
Yeah,
knowing that even if things get a little rocky, you've got a way to handle it.
that's the key. And that plan, it should really be tailored to, your risk tolerance.
Oh, totally. I
Yeah.
mean, some people love riding those market roller coasters,
You're right.
but others are like, nope, give me something a little more mellow.
It's all about knowing yourself, How much volatility can you handle? Not just financially, but emotionally too. Because let's be honest, watching your investments go up and down all the time, it can be nerve-wracking.
Oh, yeah, for sure. And, I think it's important to remember that investing, it's not just about the numbers. It's about your goals, your dreams. What are you working towards? Is it a comfortable retirement? Maybe that down payment on a house? Or maybe you want to retire early and travel the world? Having that clear purpose in mind, it can really help you make smart decisions even when the market's going crazy.
Absolutely. It's about aligning your investments with your values and your aspirations.
I want to go back to something you mentioned earlier about active investing. You were talking about how understanding those market shifts, those big changes happening in the world can help you find opportunities. Can you talk more about that? It seems like there's a lot going on right now that could create some really interesting possibilities.
Oh, for sure. The market, it's always changing, right? Reacting to new technology, global events, shifts in consumer behavior. And the savvy investors, they're always looking for those emerging trends, the ones that could signal big winners or big losers.
So it's kind of like you're trying to predict the future.
Well, you can never predict the future perfectly, but you can try to understand the forces that are shaping it. For example, let's think about the rise of artificial intelligence.
AI. Yeah, it seems like it's taking over the world.
Right. It's transforming so many industries, from healthcare to finance to manufacturing. So a smart investor might ask themselves, okay, which companies are really leading the way in AI? Which ones are going to benefit the most from this whole technological revolution?
So you're not just buying a stock because the company has a cool name or a fancy logo. You're really doing your research trying to understand its potential for growth in this
Yeah.
new AI-driven world.
Exactly. You're looking for companies that are innovative,
Yeah.
but also financially sound, with strong leadership and a clear vision for the future.
So it's kind of like you're a detective trying to solve a mystery. You're looking for clues to figure out which companies are going to be the next big thing.
Another big shift we're seeing is this growing focus on sustainability and what's called ESG investing. That stands for environmental, social, and governance factors.
ESG, I've heard that term. But what does it actually mean for investors?
It means more and more people are looking for companies that are doing good in the world. Companies that are committed to ethical practices, environmental responsibility, and social impact.
So it's not just about making money anymore. It's about making money in a way that aligns with your values and makes a positive difference.
Precisely. And this whole shift towards ESG investing, it's creating so many new opportunities in sectors like renewable energy, clean technology, sustainable agriculture, and businesses that are focused on social impact.
So if you're passionate about something like fighting climate change or promoting social justice, you can actually invest in those causes.
Exactly. You can use your investments to support the things you care about and potentially make a profit at the same time.
It's a win-win. You get to make a difference.
And grow your wealth. These are just a couple of examples of how understanding these big market shifts can really help you make smart investment decisions. The key is to stay informed. Pay attention to the trends that are shaping the world and think critically about how those trends could translate into investment opportunities.
So active investing, it's all about connecting the dots, seeing the big picture, and figuring out where things are headed.
Exactly. It's a dynamic and engaging way to approach investing, and it can be super rewarding for those who are willing to put in the time and effort.
But it's important to remember that active investing, it's not some get-rich-quick scheme. It takes patience, discipline, and a willingness to learn from your mistakes.
And even the best investors in the world, they make mistakes. The key is to learn from those mistakes, adapt your strategy, and keep moving forward.
Okay, we've talked about so much today. Historical market trends, how investors think those valuation metrics, the difference between passive and active investing, and the importance of understanding those big shifts that are happening in the market. But I think the big question on everyone's mind is this. Do you see the market right now as an opportunity or a warning sign?
That's the million-dollar question, right? And there's no easy answer.
Because on one hand, you've got those record highs the market's been hitting, but on the other hand, you've got those warning signs of overvaluation, rising interest rates, and all that geopolitical uncertainty in the world.
And it's so important to remember that every investor is different. We all have different financial goals, different levels of risk tolerance, and different time horizons.
So what might be a golden opportunity for one person could be a total disaster for someone else.
Exactly. There's no one-size-fits-all approach when it comes to investing. The key is to do your research, understand the risks and the potential rewards, and then make informed decisions that are right for you and your specific situation.
And that's really what this whole deep dive has been about. We're not financial advisors. We're not here to tell you exactly what to do with your money. We're just trying to give you the knowledge and the tools you need to make those decisions yourself.
We want to empower you to be confident and informed investors, no matter what your level of experience is.
Because at the end of the day, investing, it's not just about numbers. It's about people. It's about your hopes, your dreams, your vision for the future.
And we believe that everyone deserves the chance to achieve financial well-being and build a better future for themselves and their loved ones.
So to everyone listening, we want to hear from you. What are your thoughts on the market right now? What are your investment goals? What questions do you have? Share your thoughts and experiences in the comments below. We're all here to learn from each other.
Because remember, investing, it's a journey, not a destination.
And the more we learn and share, the better equipped we'll all be to navigate that journey and reach our financial destinations.
So keep learning, keep exploring, and keep investing in yourself and your future. Before we wrap up, I want to leave you with something to think about.
Okay, hit me with it.
Imagine it's a year from now. Okay. We're sitting here having the same conversation about the market. What do you think it looks like? Has it just kept going up and up? Or did that correction finally happen, the one everyone's been worried about?
That's a good question. But we're not talking about like actually predicting the future, right?
No, not at all. It's more about just mentally preparing yourself for different possibilities. Think about what you would do if the market kept booming. And then what would you do if it took a nosedive? Would you hold on to your investments? Maybe change your strategy? It's helpful to think about these things now so you're not making decisions based on fear or panic when things get crazy.
That's so true, because when the market's going haywire, it's tough to think straight. Having a plan in place beforehand can really help you stay calm and make those smart choices, the ones that'll help you reach your long-term goals.
Exactly. And, at the end of the day, the best investment you can make is always in yourself.
Oh, I love that.
Keep learning, keep growing, and never stop striving to reach your full potential.
That's such a powerful message.
Yeah.
Because when it comes down to it, financial success, it's not just about picking the right stocks or timing the market perfectly. It's about having the knowledge, the skills, and the right mindset to navigate whatever comes your way and take advantage of those opportunities when they pop up.
Couldn't have said it better myself.
Well, folks, we hope you enjoyed this deep dive into the stock market. And just remember, we're not financial advisors. We're just two people who are really passionate about helping you make sense of this whole investing world.
If you enjoyed this conversation, please give us leave a comment with your thoughts and share this episode with anyone who might find it helpful. The more we all learn and share, the better off we'll all be.
And until next time, happy investing.